We are looking at the NASDAQ, and we had our opening here, and there's a 15-second chart in lower right. We just traded through the new day opening gap of last Friday. So on the 5-minute chart, I have that in the left-hand lower corner. So we have our discount opening range gap right here. Midpoint is right there. Just so happens to be an old new day opening gap low in close proximity to that. So we'll see if we can get a little bit of a bounce in here, get up in the opening range gap. 474.50 is where I'm focusing initially, so that way I'm not trying to force a bias. I'm not trying to have Caleb know for sure what direction to work within. First thing we do is we watch and see if there's any formation of a gap. We have a pretty respectable one this morning. Alrighty then, now let's look at the 1-minute chart here. I'm waiting to see if we get a fair value gap there. Again, the first few minutes of trading, let them have it. Let them do whatever they want to do with it. Jumping in it, trying to predict what you should be trying to do without looking at price first, a little foolish. Now, 15-second chart, I like how the bodies have been respecting this new day opening gap. Hourly chart, this wick right here. I'll show you that one right there. Watch the 334.5 level. If we can go down there and touch that. Getting through that with a lot of momentum sets us up for maybe a run into that Thursday end dog. Not co-signing that one yet. I'm just sitting still and relaxing. No reason to chase it. So today is the first day of our week where I'm trying to teach my son entries and how to pick the right fair value gap. So we have our consequent encroachment level here. 1-minute chart, we have our first gap right up in here, real small, right there, tiny little thing. So big give back today. There was the a medium impact news driver came out 8:30. So far we had a really good gap opening lower. We go back to regular trading hours on the 5-minute chart. So still a very large opening gap, just opened straight from Jump Street and traded lower. Sell side below here, and that wick, that red level right here, that's this wick on the hourly chart, upper left hand corner chart. It's the wick underneath my cursor right there. That middle of that wick is what I highlighted and told you to watch that. That's this same level down here in the lower left hand corner chart. This is a 5-minute chart. We went below the sell side here, and we're trading inside of this gap that's on the 12:50 p.m. from last Thursday. And there's the opening range gap on the 15-second chart. Mid gap is here. So that's consequent encouragement of the opening range gap. If you look at the 1-minute chart, that's real nice right there. Clean, equal highs, straight down right from the opening. So you know what retail wants to do. They want to be short. And we have a new day opening gap low here, just close to that mid gap. So some of the exercises I'm going to show you today, but each day I'm going to teach you what you can practice with using the lower time frame charts. Now, each day I'll do several examples based on what the market is presenting to me. There will be times where I will say, this is what would look like a fair value gap, and we'll test using ones that I don't necessarily agree with. So it gives Caleb and all of you a chance to see what it looks like when you're not doing it correctly and how you'll be able to identify it right away. If the fair value gap is valid, these are the things I personally look for. If they don't have all of them and they have a few of them, you can still practice with it. But if you get an adverse result, don't beat yourself up about it, because they're drills. Drills are their practice session. You won't get good at entries until you practice them a lot. As you can see, I have it set to 1 contract. And today I'm going to be doing just primarily the discussion on the mini contract. All right, some of the things I like to look for is like we went down below this low here, straight shot right from the opening bell. We have all these wicks in here, and generally, even if it is inside of this SIBI here, folks will look at that and think that that's something to go short on. I like the fact that it went down into that volume imbalance right here on the 1-minute chart with this candlestick here. And now I want to see, does it want to go higher to reach back up into end dog here, and then maybe get up into the buy side there and see if we can get to mid gap, which is consequent encroachment, that red level up here. We'll go back into a 15-minute chart, upper left hand corner. So when I'm trying to teach students, but what I would do is I would give the ideas of what I want to see in price that would either frame a setup. For instance, if we make another attempt to go lower, I already outlined that I want to see it fail with this sell side and bounce buy side inefficiency. I would rather see this one fail. That's what I'd like to see. I would like to see that one fail, meaning that since we went to the top of it here and here, if you split that inefficiency in half, I want to see it stay in the upper half. If it has any retracements, I don't want to see it go back in the lower half. Right away, we're talking about how to look for fair value gaps that shouldn't be viewed as a shorting opportunity, because you would have been stopped or very close to being stopped out already. Because the rules are, whatever the fair value gap is that has the imbalance candle, there's always 3, okay? There's 3 candles that make a fair value gap. Your eye is being trained. Every time I draw attention, like I mentioned this one here, you should already have that screenshot. Some of you you saw this one right here, and maybe you did take the short in here. And if you would have used the rules, the stop loss would be above the number 2 candle in the 3 candlestick formation that makes a fair value gap. So if we look at it like this, 1 candle, 2, and 3. If the market has moved lower, this candlestick in the middle, that is your kind of like your trigger candle. That's the one you're watching to see stay open. This is number 1 candle. This is number 2 candle. Number 2 candle is where your stop loss is. That's your, if you're really trying to use the most leverage, placing your stop loss right there. The conservative stop, the number 1 candle, is where your stop loss is. If the market price is down below here and you're looking for lower prices, even still lower than that, if the market trades up, this candlestick number 3, this is your entry. That candlestick's high or 1 tick below it. If you're absolutely 100% certain that you believe strongly that it's going to drop, I will use a 1 tick below that candlestick's high. Now, you can do something like this. The low and the high, that is your consequent encroachment of this hypothetical fair value gap. So this to this candlestick's high, that's your sweet spot. In a perfect world, if all things being perfect, this is your ideal entry point right in here. And you want to screenshot that. We've seen it go down into the lower half of this SIBI, which is a fair value gap that has a down close. It knocked out anyone that went short, traded down once more to the consequent encroachment, a mohawk, which is just coloring outside the lines, and trading up into that end all new day opening gap. Right here, the liquidity is this. That's your buy side. And then up here is mid gap or consequent encroachment of the opening range gap. And that's all that we need to worry about at this moment for you. So we have a small little gap in here. Notice it's over here. It's the same thing, just going lower. So we have a fair value gap there, and we have a fair value gap right there. This, to me, isolates all this price action. So I view this as a balanced price range. I would prefer it not to see that fill in. It doesn't mean if it goes down and fills it and touches this candlestick's high or the small little volume bounce that has to be included. Like if you're drawing this fair value gap here, you can't just use the wick to wick like that. That's not valid. That's not valid. You want to use the volume imbalance that's part of and inside of. That's incorrect. That's valid. You're taking consideration that the difference between the two bodies, that they are not touching. So you have to have all the way down to the previous candle, or number 1 candle in this case, which is the opposite of this. We want to see it trade above the end dog, come back down. It can use the top or the midpoint of that, spring from that up into the minor buy side, maybe hopefully accelerate and reach into that mid gap. Back to this discussion here for fair value gaps. So since number 3 candle, that is your entry candle. Number 2 candle is your framing of the fair value gap. What's the part that's the area where price should come back and revisit it? It's the candle that has no previous candles low touching the next candle after. In other words, in a perfect world, this candlestick should touch this candlestick and have a bridge between those 2 price points. But as we see here, it's being shown with just 1 candlestick. So it's 1 pass through or single delivery between this candlestick's low to where this candle makes its high. So as soon as the next candle, number 4, opens, you have a valid reason to anticipate a return back up into that fair value gap. It may not do so. It may just keep on dropping down. If it does, just let it do it. Don't worry about it. Your focus should be in the mid part of the gap that is framed by this candlestick's low and this candlestick's high. This midline is basically going to give you the same thing that you get when you put a Fibonacci on it and have the 50% level. It's consequent encroachment. It's the midpoint. If we're bearish, the ideal optimal entries are going to be formed at the lower half. Why? Because you want to see that upper half, this level up to this candlestick's low, stay open. You want that to remain open, because if it does, that means you have a very strong probability that you're right and you're going to be on side. That's a fun thing to be on. And there's signatures that the algorithm signals to you that that's what it's trying to do. And you don't have to worry about it. You're not fearful of it. You're going to smoke that minor buy side. Why we are not trading in zones, okay? There are specific price levels. This low of that candle number 1 to candle number 3 is high. That's what I have a Fibonacci on. But what you're looking for is, I personally, this is my favorite way of doing it. Because if you look at my charts when I'm doing executions, you might see where I'm just a little bit ahead of a fair value gap, or I'm just a little bit ahead of a bearish order block, because I know what I'm looking for. So I want to make sure I get filled, because I'm trying to trade in markets that are very heavy when I'm bearish, or very, very light and more likely to run higher when I'm bullish. So I want to make sure I get filled. I don't like missing my entries. I'm not worried about missing the trade. There's very specific price levels. And what are they? They're this. It's the high of candle number 3 when you're trading a bearish fair value gap. Look at that buy side. Look at that. That price right there, if it trades up into that, you can be short. I would be short 1 tick below this candlestick's high. And then if it trades up to the lower quadrant of this gap, I'm adding 1 more. That's the 4 contracts. So I'm going to enter short entry 6 contracts at candle number 3's high. less one tick. If I'm not there at the time to get that on, as soon as it trades to this candlestick's high as it's happening, I'm going short rate the market. And then I'm watching price. I want to see price kiss that lower quadrant level that makes that fair value gaps range. Okay. I'm going to add 4 more there. And then whatever I feel comfortable with, if I get another opportunity to short, that'll happen if it touches consequent encroachment. If, and it doesn't always happen, if it trades up in the upper half. In other words, it does this. Now we're up in the upper region. Now I have a real deep discount. I'm sorry, premium. I'm trying to sell at an extremely high price. Then what I'm going to do is I'm going to toss in like 2 more contracts. As long as it's spending time up in here and it keeps tapping, and if it shows the body staying inside of this candlestick's low, number 1 candle's low, I will allow it to wick through that. And it's okay for it to do that because my stop loss is going to be resting 1 tick above this candlestick's high. It's going to take a real move to disrupt that. So we have this level here that we allow for the wicks to form through it, but we don't ever want to see the bodies close above it. We don't want to see that. So that's how I'm internalizing what I'm expecting when price is trading up into the fair value gap. My entry price point is specific. We have to know what levels we're trading. Okay. So if it's going to trade in above the midpoint, and it's giving me a real high premium price, what price level am I going to aim for there? The upper quadrant level. Now tell me, how's that for logic? I know exactly what I'm looking for. I know exactly what price I'm aiming for. And I know exactly where my stop loss is going to be at. I'm not wondering where I should put it at. I'm not worrying about if it's going to get hit, because if it hits it, then that's wonderful. That means I'm probably looking at an inversion fair value gap, and I can mitigate that loss very easily. You have to have a logic in mind how you're going to look for the pattern. But visually, as a teaching aid, the fair value gap is good. The first presentation fair value gap right there. That's okay. So here's first presentation fair value gap. So now we know the prices. We know how we're going to build in pyramided positions. If I'm not saying you should do this, if you're first time trying to learn how to do this, do not try to pyramid, please. Don't try to build big positions. Just try to trade 1 contract and use the easiest low-hanging fruit objective. Entry, that's this one down here on candle number 3. It's high minus 1 tick. Okay, you're going to practice with that. You're going to do it with market orders first, so that way you're going to time it. What this does, it helps you with your anticipatory price reading skills. It's better to use limit orders, but it helps you understand how to time the market and how to read it with your marketing in. When you start trading with your real money, the only time you should be really doing market orders is just to get out of something that you need to protect your money with. I'm a strong believer that your exits should be on limits and your entries should be on limits, or on rare occasions, buying on a stop or selling on a stop and as an entry mechanism into it. And you see what that was there? It was a stop hunt below that short-term low. The wick went all the way down. Look where the body stopped, above first presented fair value gap. Mid gap still is on the table. So low-hanging fruit entry pricing for a 1 contract, you're going to be executing on the micro. It's about the process of simply following the rules and desensitizing yourself. But if you make it exciting or terrifying, you're not going to learn correctly. You're going to learn to be fearful of the outcome because you're doing it with a monetized reward or punishment at the end of it, versus you're only going to be tape reading and you're only going to be doing what? 1 single micro contract in a demo. That's it. And you're going to do that for a little while until you get bored with it. There is no time limit, but it should be at least a month. All right, so this would be accomplished by taking candlestick number 1's high. Candlestick number 3's low would be on candle number 3's low as the buy. So same idea, just in reverse. When you're expecting the market to go up some higher price, okay, and you're watching price deliver, and you see 3 candles. 1 candle's moved and delivered price. The second one delivers price higher. Then the third candlestick trades higher than number 2's candle. But number 3's candle's low does not touch or overlap with candlestick number 1's high. That candlestick number 2 in the middle, that is your trigger candle. That is your fair value gap. If you're long or looking to go long, you're going to use this candlestick number 3's low plus 1 tick. That's my entry. If I am watching it and it trades down and it gets into the upper quadrant level here, then I will add more. So by having the market trade down to the upper quadrant and as low as the midpoint or consequent encroachment of this gap that separates candlestick number 1 to candlestick number 2, this whole pattern here is this right here. This is candlestick number 1, candlestick number 2 in the middle. This is candlestick number 3, this one. So because we're using the volume imbalance here, that's how you would draw down to here, where I'm using the high here. If there is a volume imbalance, which is a separation between the previous candle body and the next candle that makes the fair value gap, that little separation, always include that. You'll have better determination of the consequent encroachment level, which is important. That's your most important level. The ideal entries are going to form in the midpoint of the gap to number 3 candles low. And you want to see that lower half stay open, not traded to. It can wick down in there. If it does trade to the midpoint, I'm going to add more. If it trades down to the lower quadrant, I'm going to add more. If I can see it touch this down here, I'm going to add more. I'm going to keep adding to that because my stop loss is going to be below candlestick number 2's low. Now apply that same logic over here. This number 2 candlestick, that's the fair value gap. The market drops down to this candlestick's price plus 1 tick. You would have been filled right there. The heat on that trade, so that's 3.75 handles drawdown. Yeah, like 70 bucks. 70 bucks heat. If you're trading with one mini, that's how much drawdown you absorb before it turned around and started going in your favor. And it went just short of what price level? That's that upper quadrant level. That price is 401.25. What is the low of that candlestick? 401.25. Did it leave the lower half of that gap open? It didn't even touch the middle. So what does that mean? It's bullish. So that means you can trust that once it gets into this little new day opening gap up here, it's going to do what? It's going to accumulate. It's going to roll higher. Cleared the minor buy side I gave you. And now it's accumulating. Again, we're sitting inside of a pool of liquidity after taking this Judas swing ride lower. Now, because we've spent this much time accumulating around the first presented fair value gap, look at the bodies. We wicked down through, but look at the bodies are showing you. It's respecting it, right? So if we can manage to get above mid gap, I'd like to see it accelerate and move higher. I don't want to see it do this, like wick above it and come back down. I would rather see it trade up above it and start building things like the fair value gap here, the gap in here. We went down and worked the lower half of this one, which I told you was going to fail. It wasn't going to provide a sell-off. Like say I miss it, or I'm doing something. Something keeps me from getting in the trade at that very moment, and say the market is now just below it. As soon as I see it like that, I'm in it. So now I have the wonderful opportunity of getting it at a deeper discount. If it can touch the upper quadrant, I'll buy that too. If it touches the consequent encroachment, I'll buy that too. Anything less than that, I'm going to do 1 or 2 contracts because I don't want to build it bigger, because down here in the lower half, I don't want to see it spend a lot of time down there if it does that at all. So in an ideal scenario, so that candlestick low plus 1 tick, in that case, it would be 19,404.25. That's where I would be entering. That's all I got to get in. And I don't care that I'm going to have a little bit of drawdown, because my belief is I'm not going to see any movement into the lower half of that fair value gap. You are already light years ahead of everybody else out there. Everybody. Put anybody else's name in there. You're already beating their ass in terms of precision, knowing what to look for. You're not freaking out. You know where to place your stop loss. 90% of these mentors out there don't even use a stop loss. They don't even know what they're using. If they have to use a stop, they're scared to death of it getting hit. I'm not afraid of that. You're not learning how to be afraid of that, Caleb. You're not afraid of getting stopped out, because I just told you in this lecture too. Because if you get stopped out with a fair value gap, it tells you you're probably watching the formation of an inversion fair value gap. And an inversion fair value gap is just going the other direction. And you can trade with half the size you took a loss on and make that back and more, and not even worry about it. You're not even worried. Why are you all fearful? You're trying to avoid losing. You don't need to feel. You don't need to feel that. So entries here, new entry there, or if you don't get that entry, if you I don't know, you're scared. You're just now practicing for the first time. Okay, and you see it touch the upper quadrant, then go in and just do it at the market. But you want to do it as it's hitting it. When price is dropping into this level, in this halfway point of the gap that measures number 1 candles high, number 3 candles low, that range, half of that, everything from this price point, the midpoint, which would in this case would be 19,365 and a quarter, to 19,378 even. Anything in that range is fair game to be a buyer, but not just any old price. Look at the quadrants. When you're grading an inefficiency, or you grade a wick, so the best buys are in that upper half of that fair value gap. Ideal scenario is when we get another candle that drops down in this fair value gap. Any candlestick that drops down in there, we don't want to see it spending a lot of time in there. We want to see 1, at most 2 times, better if it's just once, entering it like that. And if it can start to run after going in just the upper half, feel confident that the lower half stays open for your benefit of knowing that you're on side. Now, does that mean you're never going to get stopped out? No, it just means that your confidence should increase. If the wick is going to be bullish, we want to see the upper half of the wick keep price from trading into the lower half of the wick, regardless if the wick is above a candle's body or below a candle's body. It's the same thing. If it's above market price, then that wick's going to be a premium array. If it's below price, then it's going to be a discount array. So if it's a discount array, the same thing I'm teaching you about the fair value gap, my PD arrays work with the wicks the same way. Look how fast it did it here. That's also a clue. As soon as the candlestick creates the fair value gap, if the next candle, number 4, drops in and he starts running, chances are stronger that this lower half will stay open. It could be a little bit of time before the market eventually comes back down into that fair value gap. But when they give it to you right away, that means it's going to be on a fast track to get somewhere quick. And that's the buy side I gave you over here. So this is also the lower quadrant to the opening range gap. But previous day's settlement here, which is Friday, this is the midpoint or consequent encroachment. That's the level that 70% of the time in the first 30 minutes, it will at least touch that in the upper quadrant level. And in the high, this is previous day's settlement. So we went above, spent some time here on the lower quadrant level. That's that lower quadrant level there. You see what it just went up there and it just hung around in that area and then broke lower, traded all the way down and through new day opening gap. And then here's first presented fair value gap after swiping below that new day opening gap of last Friday. And then trading up into that and then breaking lower, remaining heavy. Now we're back down into this inefficiency. So I'm going to remove this now. Hopefully it's communicated clear enough for you to know what I'm talking about and referring to. If you watch my examples now, you'll understand a little bit more what I was doing at the time of the execution. Alrighty, now let's real quick why did I tell you at the beginning of the live stream that this was not a shorting opportunity? We had started the morning consolidating. This is electronic trading hours. It spent a little bit of time meandering sideways, and then it broke initially right away. After it had already dropped from previous Friday's settlement price, we had already, if we would have opened back here at 906 or 849, that's significantly lower than Friday's settlement price. So we were already set up to have a big gap opening lower. And then if you have a lower gap opening that's in the cards and then you watch the 9:30 time window come to pass, and now here at 9:30 we open and they just send it lower, that's a Judas swing. You don't ever want to chase something like that. Let the price run. When you start seeing the market create a swing low and then you right at that point, at that candlestick's close there, that opening, that's when I'm going back through all of this to look for inefficiencies, order blocks. Anything like a short-term high where buy side would rest, well, there is none of that in this. It's just a one straight shot lower. So that also is characteristic of a Judas swing. It's something fake. They're going to run right back over top of that. If you look at the range that was created on this drop down to that low, where is this inefficiency at? In other words, the thing I haven't shaded here, that is a fair value gap. It is a SIBI, a sell side imbalance, buy side inefficiency, but it's in the lower half of the price drop from the opening bell at 9:30 to create that swing low. And I seen that as soon as that candlestick closed and this one started trading, I said, okay, this one here is fake. And they rally it up into that and they give you these little dojis and make you think, wow, it's going to drop. And I told you, nope, it's not going to drop. I'd rather see it trade higher. And once it trades higher, it can come back down in, but stay inside the upper half. We just saw a mohawk right there. It didn't go down to the lower half. Once it left it, that's how you know behind the scenes, the algorithm is saying anybody that knows this information, they're going to expect that that's not going to trade lower. And then it starts to rally. Once it leaves this inefficiency, you have several things you can look for. A return back into the top of that inefficiency to treat that as a discount array. In other words, come down, hit it, and repel it higher. Or what do we have in price? The tallest wick right there. This candlestick leaves this inefficiency the way we were looking for it to do it, higher. So it's failed because it's in the lower half. Now, if this inefficiency was all overlapping candlesticks, but then this one was there, then I would say if it got to here, I would look for it to sell off. May not need to take out the low that formed there, but that would be one that could be tradable. But here we have the consequent encroachment of this wick right there. So that means when this candlestick went up here and stopped, the next one we opened, it's reasonable to anticipate it to do what? Trade down to this candlestick's midpoint or consequent encroachment. To do what? To send price higher, because this is a discount array and price goes higher. And then we get that fair value gap that we've been talking about. What is this? Trade down into it, inversion fair value gap. Sends it where? Lower. It's going to go down into this inefficiency, not to create a buy, but to fail. So, and again, if this is the only fair value gap that exists below the halfway point of that drop lower, and it's the fact that we dropped straight from the opening, that's what told me that gap is not something to go short on. It is something that you expected to go higher. So I'm looking for retail traps. I know how a time distortion will make traders say the chop is real and get all screwed up or not take a trade at all. when I can go in there and I can see what it's doing and I can engage in. And that's what we were looking at here. When we see these little wicks in here, and everybody else that thinks they understand inefficiencies because it went up there like that, they think it wants to go lower. And I'm telling you the logic is no, because right at 9:30, it dropped initially straight down when we already was expecting a lower gap opening from Friday's settlement price. So it's already going to be opening at a real deep discount price. And then add to it, it opens and sells off. That's the public selling it. They're chasing. They're going to sell short. And anything that they see as a reason to get short, they're going to take it. And what do? They lay the bait for them. Dojis inside of an inefficiency, because you have an opportunity to trade to the first presented fair value gap. That could be your target. That would have been filled right there. What if that's all you decide to do? It's actually a low-hanging fruit objective, because the draw would be high of day, opening price, buy side, lower quadrant of the opening range gap, mid gap. They're all potential areas where a partial could be taken, or any one of them could be your terminus, your end target. So I'm providing you where the market's going to draw to, but you decide how you're going to frame it. Is it going to be the easiest one to get out of and be done? That's what all of you should do, starting there. The easiest exit point that you can see, that you can comfortably wait for, and get in the easiest first opportunity, low-hanging fruit entry mechanism. And I taught that to you here today. Exiting, you're looking for the easiest exit. If you're expecting it to trade higher here, well, what's the first gap? That's this one here. The liquidity here, the lower quadrant. You have the gap that we've been talking about that's inside that. So, but the targeting aspect of what you're looking for, first 30 minutes to 10 o'clock, you're always looking for an opportunity for it to try to get to the halfway gap. So consequent encroachment of the opening range gap, in my mind, that is my always first draw. I want to see that, because there's a 70% chance that's likely to happen. If there's something before this level, like these smooth highs, the opening price, if you aimed for that, that's a good level. And you have the first fair value gap here. So does that give you much room, leaving this area here where we said it live that this wasn't going to be a sell? It's actually something you want to see it trade higher from. It doesn't give you much room to profit, because we're thinking it's going to go up to opening range gap. How can you use this inefficiency here? If you didn't look at the fair value gap like I outlined it, and you were looking at this correctly, the gap in here, this drop down into that fair value gap is also tapping into this gap, which is, if we're expecting it to go higher here, is this gap a sell? No, because the opening range gap midpoint or consequent encroachment is up here. It's still likely to be traded to. Here, what time is that? It's 9:48. What time is this candlestick when it would have gave you a buy based on everything we've been talking about in this live stream? It's 9:50. What is that? Macro time. 10 minutes to 10 to 10 minutes after 10. That's your macro. It's going to do what? Run to inefficiency or run to liquidity. Okay, well, we know that bias-wise, it's likely to draw up to half of the gap. So how do you find something that's profitable in that model? If you see this as the first fair value gap, well, then you would expect it to trade through this gap here and do what? Find a support, treat it as a discount array, and rally higher. At the time when we were watching it, we were looking at how these candles shared the same space between the two. One was offering it to the downside, one was offering it to the upside. So this is treated as a balanced price range, and the market rallies higher, attacks the buy side, the lower quadrant level of the opening range gap, and then did not trade to opening range gap consequent encroachment. But what did they leave here? Now that's primary buy side liquidity, because we cleared a higher high of the day. This is initial high of the day at 9:30. Drop, Judas, rallies over top, all that price action, reaches into the lower quadrant, fails to get the opening range consequent encroachment of that gap, and then they leave high, lower high. That's a valid trap. So traders that are trying to go short, their orders to protect that short are resting right there. It need not trade to it today, but you have to have that level as a key level until we go through it this week. That's a level that I have in my notepad. If you don't have a pad, a writing instrument next to you while you're watching price action, you're doing it wrong. Because if it only appears inside your chart, you're not doing it right. I look at the raw numbers when I'm done. Like I'm away from the charts. I look at the raw numbers and I think to myself how they might use it in the next session, which is the lunch macro. And then I look at how the numbers are used for the afternoon. I formulate a possible scenario, because I know this is the high of the day now, and they formed it with relative equal highs. We've broken minor sell side, but this has now been broken. So that minor sell side, this now is primary sell side, because it's taken out the initial low of the day. So here's primary sell side, primary buy side, because it's taken out a high here, and this low is taken out here. So to take out this low is a much more meaningful event, a lot more meaningful how we trade around it. Now, because we've taken this low out with this drop down, we rallied up, consequent encroachment of this gap over here. When we traded down through it here, you see how it offered it as a premium array, and then sold off into this inefficiency right here. Now that we're rallying above, I would like to see this now with the color that it is here. I'd like to see it treated as a reclaimed fair value gap, where we would have expected initially, if we were not fully understanding what it is that goes on in the marketplace. The first time it drops into that, someone might think that, okay, that's one of those ICT buys, when that's the draw there. And we knew that when this was a inversion fair value gap earlier. We sold off from here to here into that fair value gap. That is a trade setup that I think that my son would do well with. It's a real easy bread and butter type setup. Now that we rally back above this gap over here, I want to see this act as an inversion fair value gap. It need not trade to it, but if it does, if it trades down into it, we can use that as a stepping stone to see if we can get to the buy side. That's a minor buy side right in here. And because you have this inefficiency over here, both of these areas in here, I'm going to watch to see if they can find some support at them or inside of them. Or if we quickly run into this down close candle here, this down close candle should not see its halfway point or mean threshold traded to. If it does, it's not good, and that means that we're probably going to go lower and probably trade lower for the duration into the lunch hour. And where we're at right now, I would be more comfortable looking for it to try to trade up into that minor buy side that I have, because that would be a little stop hunt inside of the run from here down. The only time we've had a stop hunt, we've done it on this little wick. I don't like that. I want to see a bodied swing high, something like this versus something like that, because we already hit that, we went lower, and then we ride back up. We haven't taken this high out yet, respecting the lower half of this inefficiency. By definition, that's actually indicating that it's weak. So you have to stop and think for yourself, what has the most money been made on most recently? Would you say being long or being short? Because this is what you do when you trade the lunch macro. So yeah, we went down into half of this gap between this candlestick's high, that low, and the bodies just went outside of that inefficiency's low over here. So it's left that lower portion open. So if we can, as soon as we trade above this high here, that cancels this inability to move to the upper half up here of this inefficiency. By me having all these things on my chart, you have to see the dynamic around how the market's operating in them. Otherwise, you're not going to fully appreciate it. I prefer to see this inefficiency support price. I like the fact that we haven't broke down yet, but if it does, the midpoint of this down close candle sets the stage for a run below that. I'm looking at these highs here as they're trying to, or build in trust that anyone that's short, they're going to want to drop their stop loss down here. And if that happens to be the case, they may take out that low or this low and then run for that area, because it'll give them reasons to buy below this low. If they take it below that low, they can buy that and then start distributing those longs here, then here, and work inside all this range back up to new day opening gap. You just want the obvious, easy setups. If it's not obvious, you can't be mad about it when you missed it. And as you do this more and more for everyone else, it's a order block right there. So since we tapped it, it needs to start delivering above here. Any failure to go lower sets the stage for a run lower into that. And then we could probably just keep dipping lower into a lower daily range. The most obvious runs where the market is clearly, in the first 30 minutes, you have a lot of advantage knowing where, if there's a large range gap, that halfway point of that gap is such an easy, it's an obvious thing. It doesn't mean you're going to be right every single time trying to trade for it, but if that's where you're going to start with as your foundation, it's going to serve you very, very well. And in this case, you saw that we had the buy side. It went to that lower quadrant, it went to that, and it just fell short of opening range gap consequent encouragement, which is still here. So what I'm looking at is I'm seeing how we left those smooth highs. Mid gap is still up here. We had a really nice short-term low that was priced in quickly. We folded, went lower, took that low out here. Failed to go lower there, but we're building this little clean area. This candlestick is to trigger whether or not we see it go higher or not. If it's going to go higher, I don't care about all the mess around here, and I can trade above this area if I want to go long to get that smooth high and consequent encouragement mid gap. If I'm aiming for that, if I'm bullish, that's what I'm aiming for. I don't have anything to do yet, but if it rolls through this mean threshold, this down close candle, if it's bullish, no candlestick should close below this mean threshold. It can theoretically stab all the way down and match the same candlestick's low. It's bad. It's not the best for something like that to happen, but in theory, it can do that. Ideally, the upper half should keep price at bay and not go lower if it's bullish. But if it can keep going down and touch that midpoint, that's indicating that it's not something good. See, that violates it. Look how fast it accelerated through the bottom of it. What you're looking at is how I'm taking an order block to frame a displacement higher or lower in that next price run. Then I have to reassess and see, what is it reaching for now that it's done this? Expecting it to fail, that's part of using the PD arrays, because it gives you sit still or go the other direction. All right, so now we have the potential of this little fair value gap right in here. But as long as we don't take out that low right in here, we might have something to work with. It might not end up becoming an immediate rebalance. Immediate rebalance is coming right back to this candlestick's low, touches that, and then the very next candle or that candle, usually we'll see it run in the same direction it was moving prior. I'd consider that immediate rebalance. I'm watching the wick. If it can stay in the lower half of it and not trade it in the upper half without taking out that high, it should roll right right over and attack that low here. So if you were looking at this candlestick like I was outlining it, if it was going to be bullish, the upper half of that, if it trades to its middle point, it indicates it's weak. So now what happens when you start trading up into that same range here, it should stay in the lower half of this candlestick and then drop down and attack that sell side right there. So if you looked at this wick here, that's consequent approaching of that wick halfway. So using the middle of the order block there and immediate rebalance, trading down to that, that's something that's tradable. That's 10 handles. That's static price action. You can get stopped out and be right if you're just trying to trade in consolidations or time distortion, which is basically what we're seeing here. This is all time distortion, which means you have to sit and wait. Wait for them to give you something obvious. And right now, it's not obvious. So it would need to do something like this. Give me a move that affords me, it has to give me this much range, because I could still probably fancy dance and get 15 handles out of that. But 10 handles like that, when you have a market that's moving around like this, on a day-by-day basis, it's not worth it. So we've taken out the sell side here. Now here's the order block. This could become reclaimed order block, bullish, and run for the buy side here. I like this. If we can maintain that, it evaporated here. A low that's taken out that low over here. Now we have this low that was taken out here. We have clean highs, an undelivered midway between the opening range gap high and low that has not been traded to today. That candlestick's low to these equal highs. That is definitely enough handles, right? And you start the clock from the time of entry. What time did you get into the trade? How much risk? This is the candlestick number 2. Stop goes below it. Here's your target. And you just watch. If it stops you out, you write down how long it took to get stopped out, how much drawdown you took on the trade, how much money did you lose. Then, if it gets to your target, how fast did it get there? And you do this as many times as you can afford to do it in your study. The lower time frames will give you more opportunities so that we can do a lot of these types of exercises. It's not a matter of being right or wrong. It's a matter of desensitizing yourself to it. You don't want to be in here trying to be accurate on every single one, because it's not realistic for you. You don't know what you're doing. You're testing the theory. It's already tried to go lower. Well, I've taken this low out here. This low was taken out here, but this low did not take out that low. And we have clean highs that could be easily trailed to for buy stops. Anyone that's short up in here or shorted there, as the market went lower, they created these smooth highs here and they took price below here. So traders that use this as a sell stop to get short, their short position is triggered to get them in when it went below that low right there. So retail's thinking that it's going to keep going lower because they've watched what? They've watched all this movement go lower. And by having that breakout below to the downside like that, it provides them a trust factor, because it's like bait. It should not go back inside of the fair value gap. If it does, that's fine. You have something that you can measure. It's not something that's going to always pan out when you do it with your live account. And going in, you're submitting yourself to what is the market doing and what's it most likely to do. Everybody primarily has made money being short today. So it's reasonable to expect that the market will try to go against those that are in profit for the purpose of taking them out of it. When you do these exercises, you're just simply looking for an exercise where you've taken, entered, reach for the trade's objective, and get out and be done. That would be a primary example of just a first partial. Say you've been doing these examples or exercises every single day for about 2-3 weeks, and you feel comfortable with it. You don't feel any anxiety. You don't feel any kind of nervousness. The next stage of your testing and doing drills is that you would look for above here. What was the next liquidity? That's this one here. So this would be first partial, and then this would be terminus. That's where you're going to grow into. You're going to look for a first partial objective, and then you're going to look for a terminus where you're done. And you don't need it to trade all the way up to that mid gap. You don't need it to trade back to its old highs and attack these relative equal highs. We don't need that. If you can frame the trade, minimum, it's got to be able to move 20 handles. It's got to have at least this much movement potential where it can traverse from one price point where you expect to get in to where you think it's going to reach for. And it need not even go to that target. It has to afford you this much range. Now, we were down here and I told you, try to hammer it with the market order. You're not going to get this price, as I'm going to show you here. So this candlestick's low. So 19,339.25. That's the ideal entry. You're trying to get at that price plus one tick. So that would be 19,339.50. That would be your ideal entry. I'm off by 1.5 handles with my fill. So the trade had $50, the difference between the actual fill and my target. The trade itself had basically no drawdown. From the time of entry, it literally was just hanging around and then took off. So what I'm essentially saying here is this is where I saw the price. As I mentioned, it's got to give you at least a 20 handle run of range potential. When that candlestick closed here, the very next candle, when it opened up right at that price and it started to drop down, I told you that you want to try to hammer it and buy at the market as it hits it, because you want to feel every bit of the emotion. You want to feel that emotional jump of rush of adrenaline, because it's going to hit you. Even though it's demo, the low is what I'm anchoring this 20 pip range. So if I'm aiming for these relative equal highs as a first partial target, this is where I want to hold my faith in seeing the price reach up to. I believe that the market could reach up to knock out the stops that would be trailed lower on anyone that's short. So the buy side here is your initial draw from where you're trying to get in at with that fair value gap. I mean, so from this candlestick's high and that candlestick right there is low. Can you see that that's the fair value gap, but it's a buy side imbalance, sell side inefficiency. So if we think that it's going to go up here and we have this one single candle all by itself, the space between this candle's high and that candle's low is not being shared in any other candlestick after it's formed. And then on this candlestick, it came down and touched this candlestick's low, 339.25. The next candlestick is the same price. So that's why I just went in at the market, because it would have been my fill one tick above that. As soon as you see this candlestick close, the next candlestick, as soon as it opens up, my mind is immediately, bang, I'm watching that. I want to see that price tick. Once it books that price and offers it to me, mark it in. So if it would have dropped down into the halfway point that makes this fair value gap, if it would have went down into the halfway point level, this is where I would add. What time is that candle? That's the 1050, 1110 macro. So right here, we have a very, very low drawdown entry. That's perfect. Over time, what you'll do is you'll see these gaps like this. And then you'll look and see if the number one candle has a wick. There to there. I'm going to take the quadrants off. Wick, right there. Consequent encroachment. You will learn over time, trusting this. You won't need to place your stop loss below the number two candle's low. You can use one tick below the consequent encroachment of that wick right there because it's a gap. Two layers of gaps. And it's already likely to only trade in the upper half. And if we see it trade down here like that, and run up. If you started your stop loss there, you can roll it just below there. And then as you leave this high, then you can place your stop loss near the lower quadrant of the fair value gap. You have to always grade your inefficiency. So when you're bullish, the best perfect scenario is the market only drops into the upper half of the gap and it leaves that lower half untouched. And that's indicating that it's extremely bullish. You're on side. You don't even worry about your stop loss. It's there to do its job. What you're doing is you're watching price action deliver. Does it take this short-term high out? Yeah, it runs right to it. Opens. Does it overtake this wick quickly? Yep. Where's it drawing to? The liquidity I told you to. And it rallies up and it consolidates. It's consolidating where? Inside liquidity. Inside the proximity of where these minor buy stops were. That's buy side liquidity. It's accumulating new longs to send it up into the minor buy side I gave you here. And they had this little move here. I want to take it into I'm actually going to go into a 1 second chart. All right. So what we're doing is we're looking at that little tiny little candlestick right there. You see that right there? So from that entry on that candlestick right at, we'll just call it the high of that one. Okay. This is the lowest tick. That price is 340.25. Less than 2 handles drawdown in seconds in terms of time. And then the market starts delivering on my. You need to be doing things that are extraordinary. That means journaling, logging all the data. How much time did it take for you to move to profit? Well, we're back on a 1 minute chart. So in this candlestick here at 11:09, so inside the macro of 1050 to 11:10, the candlestick here, that's 1 minute, 2, 3, 4 minute, goes to target. Bang. If you're going to do the drill like this, you're always going to look for one easy objective to reach for. That's your first partial. And then where's your exit and you're done for the day? That would be here. So how long did it take to get to that? So you entry candles, count that as 1 in 10 minutes. To only have $50 total cost in drawdown to make $630. One-way ticket, just like that, no heat, 20 handles, that's enough to take that trade. You can afford to take that trade, Caleb, because if your target's above that, this is a really good setup because it's almost twice as much that you need in terms of the range. So where you're trying to get in the trade and where you're hoping to get out as your first target, it has to at least have this much room. Okay, and 20 handles is what's being shown here.